The one area where this comes up the most are with our flipping clients or our development clients. Why? Because many people who get into the flipping space or the development space, they pour out a lot of money up front before they've been paid, right? You put a lot of cash into buying the property and then fixing up the property. However, when you're putting that money into fixing up the property, the IRS has said All right, welcome back to the Know Your Numbers REI Podcast. This is your host, Chris McCormack. As always, honored to be with you. And today we're going to be talking a little bit about real estate specific and the deduction that I have seen get most misunderstood, most misreported, and cost taxpayers the most in taxes. This is the repair versus capital improvement discussion. Now, there are two sides of this story. One is that you classify everything as repairs and get an immediate deduction. And it looks good in the short term because you offset a lot of your income, but in the long term, it can have some severe consequences because it's not what is required of you as a real estate investor who is called to report their income and their expenses correctly and in line with the tax code. The other end, the other side of this coin or double-edged sword or whatever you want to call it is overcapitalizing. It's depreciating things for longer than they need to and depreciating things that could be written off as an expense. This results in a larger tax bill. It again is not in line with what the IRS is asking of you. And so it's not the right way of doing things, but you probably won't get a notice from the IRS saying you're capitalizing too much. You should really think about making these expenses repairs and pay us less money. So one is gonna result in them trying to go a little further into your numbers and get a little more information from you that probably won't result in a favorable outcome for you. The other will end up with silence on behalf of the IRS, but it will result in lower dollar amounts in your bank account and lower equity in your property. All that being said, we're going to jump into the discussion on capital improvements versus repairs. If you get any sort of value out of this, please do us a favor. Like, review, share it with a friend, subscribe. That really helps us and helps other people find it because the more people that we have reacting and responding to our content, the more people that they're going to drive it to. And if you know anybody specific who has been asking about repairs and improvements or maybe talking about large improvements that they're doing to some of their real estate properties, share this with them. They're going to want to make sure that they listen. So, repairs versus capital improvements. I gave a little insight there. One, repairs are able to be deducted in full in the year that they are expensed. So these are typically your smaller level expenses, right? Maybe it's a window that got cracked or broken and you have to fix it up. Maybe it's the amount of money you spend repairing the toilet as it started to break down, unclogging the sink, unclogging the bath, unclogging the pipes in your rental property while tenants are still in there. Those are all things that can typically be categorized as repairs. They're expensed in full in the year. So if you spend $500 on a repair, you can offset $500 worth of income for that expense. It's great, but where you get into trouble is when you put too much into your repairs category. They have this other category that is known as a capital improvement. Capital improvements are depreciated over a certain amount of time. It's usually considered something that increases the value of your property and is greater than a certain dollar amount and results in equity being built into your property, increases the value, as I said, and you have to depreciate that amount over the course of time, whether that's 27 and a half years, 15 years, 7 years, 5 years, whatever. Rather than taking the full amount in the year that you expense it, you have to actually depreciate it over time. You can see why this matters, because if you are classifying what should be a capital improvement as a repair, and you take a $5,000 expense for something that was actually should have been an improvement, you're offsetting $5,000 worth of your income, when in reality you should be depreciating that $5,000 and only getting a portion of that write-off. It results in a lower reported income amount to the IRS, which they don't like. And so if they're picking up on it, you're at risk of losing an audit and having to pay penalties, interest, fees, all that bad stuff. On the other hand, if you're capitalizing repairs as improvements, you are losing out because you are paying more in taxes than is necessary. Say you have a $1,000 repair that is truly a repair and you depreciate that over 5 years. You get a $200 expense in year one when you were eligible for a $1,000 expense. You can see why it's so important for you to get this right. One results in a lower tax amount, rightfully. One results in a lower tax amount for you. That's classifying repairs as repairs rather than improvements. The other might result in a higher tax amount, but it's in line with what the IRS requires. And we want to be in line. We want to be of integrity. We want to be honest, because there's no sense in lying. There's no sense in opening yourself up to the potential for an audit. The reason lying is so grievous, the reason lying is so grave is because it destroys your soul, right? It forces you to say something that does not line up with what's true, and then you're left with the anxiety and the fear of what could happen if somebody finds out. That's why it's in the 10 Commandments. That's why we don't feel good when we feel like we've been lied to, or if we've lied by chance. Like, that is not something that we want to be a part of. Hey there, this is Chris. Thanks for listening to the Know Your Numbers podcast. Listen, if you are a real estate investor or business owner and you're set to cut a massive check to the IRS this year, you're going to want to hear this. Right now, I am taking on 4 new clients who want to save $400,000 or more in taxes. But the catch is this: what we are currently giving out as a complimentary tax assessment will soon be charging money for. So you only have a limited amount of time to get in the door. So the first 4 people who are willing to save $400,000 or more on taxes receive it completely free. Now is the time to plan for taxes, to save on taxes. And if you want to get in on this limited time offer, a free tax assessment with Better Books, you can do so by finding time on our calendar linked in the show notes. I look forward to meeting you and seeing how we can best partner with you for years to come. So we don't want that hanging over our head. We also just want to be people of integrity. And so we want to do things the way that we're required to do them. We also want to keep as much money as we legally can. And so we want to get this right. If we're able to expense more than we're able to capitalize, that's a good thing for us, and we want to be doing that. But if you're working with a CPA who doesn't understand this, or doesn't understand what the expenses were on your end because he hasn't had a conversation with you, or he's just a little too conservative, then it's going to result in you not getting what is rightfully yours. So who needs to be on the lookout for this? I think the one that I see the most, the one that I see this the most in, the one area where this comes up the most are with our flipping clients or our development clients. Why? Because many people who get into the flipping space or the development space, they pour out a lot of money up front before they've been paid, right? You put a lot of cash into buying the property and then fixing up the property. However, when you're putting that money into fixing up the property, the IRS has said that everything has to be categorized as an improvement, because your product, what you sell, is the property, the finished property. It's very similar to a company that sells goods, right? I worked in a grocery store starting out. When I was 16, that was one of my first jobs. First job I had was a baseball umpire, but first job after the age of 16 was a grocery store employee. I worked in the deli, and it was a lot of fun memories, right? I started to understand how business worked. And then when I started taking accounting classes, I started to understand it even more. They have what's known as inventory. They buy products, food, and it sits on their shelves. And then when a customer comes in who wants that food, they take it, bring it to the register. Their internal systems say that this block of cheese and this loaf of bread are being sold. It's no longer in our inventory. We need to record that. And so from an accounting perspective, what they are doing is they buy the loaves of bread to start. They don't get to write that off on their tax return until it's sold. That's when it comes from inventory to cost of goods sold. So inventory is an asset. You basically invested your money into this loaf of bread. And then when the customer comes in and says that they want the loaf of bread so they can go make peanut butter and jelly sandwiches for their kids, they go get it off the shelf, take it to the register. It's now the customer's. They paid for it. You generated revenue. You get taxed on that revenue, but it can be offset by the cost of goods sold, the cost that you paid for that loaf of bread. Real estate works very similarly. If you're in the flipping space, if you're in the development space, when you put money into this property, when you buy it and when you fix it up, it is not an expense. It is on your balance sheet as an asset. You don't get the write-off on your taxes until your customer, the home purchaser, the person buying the property, comes in, purchases it. You can offset that purchase price, the sale price for you. You can offset that by the original investment that you made plus the improvements that you made as a form of cost of goods sold. You are then taxed on the profit. Can you see where this can get into trouble and can get a little confusing, right? If you, as the real estate investor, as the developer or the home flipper, think that you can write off everything that you are incurring in the investment of this property when you're incurring it, then you are believing that you are going to be able to offset all of your income for the year with those expenses, regardless of whether the property sells. That's not the case. This becomes an issue for just about every flipper who's getting started and is holding a property at year end, because they've poured a lot of money into this property. And maybe they've used money, or maybe they've made money on another property, but they've been believing and hoping that they can offset it with the funds that they're pouring out into the next property that is held on their balance sheet at year end. It's not the case. You can't offset that income you can't offset any income for the expenses with the expenses that you have incurred for a flip until that flip is sold, because those expenses are not repairs that go on your profit and loss for the year. They're actually investments. They're capital improvements, and they need to be capitalized and carried on the balance sheet as an asset. Now that's flipping, that's developing. What about you as a long-term investor? How does that fit into your tax return? Let's think about it. If you are putting on a new roof and it's going to cost you $25,000 and you say, yes, I can get a new roof. I've been wanting to get a new roof and I can offset $25,000 worth of rental income. Because I'm a real estate professional status, I can generate a loss on my tax return. All of my wife's income from her W-2 is going to be offset. This is beautiful. Not the case. A roof and any expense of the $25,000 mark has to be carried on your balance sheet as an investment, as an improvement. So rather than expensing the full $25,000 in the year that you've poured out the cash, you actually have to carry that and depreciate it over 27 and a half years. So you paid $25,000, but you're only going to get about less than $1,000 on your property Schedule E, the tax form for your rental portfolio. You're only going to get less than $1,000 of that $25,000 because it's depreciated over 27 years. So this becomes an issue when you're expecting one thing, but then you are told another thing as a result of the way that the tax code happens. So what are some things that you should be aware of? De minimis, safe harbor. IRS publication 527, the de minimis safe harbor, says that if you are paying $2,500 or less for any item that you're putting into your property, it can be categorized as a repair, assuming that you make the election for this de minimis safe harbor on the preparation of your tax returns. There's a lot to consider, right? It's any one item that's $2,500 or less has the ability to be a repair in the year that you expensed it, assuming you make this election. So what do you need to keep track of? How much did you pay for the item? You want to make sure that you have an itemized list of what you're paying for so that you can qualify for the safe harbor for as many things as you're paying $2,500 or less for. Number 2, making sure that it's recorded as a repair in your books, right? Whoever's doing your books, making sure that they're aware that this is a repair. If it's you got to be aware. If it's somebody you've hired, they got to be aware. That's why it's important to hire real estate focused bookkeepers. And then number 3, making the election on your tax return. You can know this, and that's why I say applied knowledge is power. Knowledge is not power. Applied knowledge is power. Wisdom is the application of the things you know. And so there is wisdom in making sure that all 3 of these things are checked. You spent less than $2,500 on an item. It was recorded as a repair in your books. Your CPA, tax planner, person preparing the taxes made sure that you made the election for this safe harbor, which says anything less than $2,500 can be written off as a repair. Capital improvements, those are things more than $2,500. Those are things that add value to the property. Other things that the IRS will look for is, were there tenants in the building when you were doing this, or did you wait until they were out of this? We have a friend who's a property owner, and just last year there was some vacancy in their property, and so they did a lot of improvements to their properties. I was sitting by and watching and knowing that all of that had to be capitalized because tenants weren't there. They had to wait until the tenants were gone to be able to do these things. Flooring, bathroom remodels, the whole 9 yards. That's a capital improvement. Has to be depreciated over 27 and a half years, unless you have, again, an itemized breakdown of what was being done and you have a competent CPA who knows flooring is 7 years, let's say, or appliances are 5 years and they qualify for bonus depreciation, right? Those are things that you want to be aware of. So if you are making capital improvements, you want to make sure that the contractors that you're hiring, the general contractors, the people doing these improvements, the people you're hiring are giving you an itemized sheet of what is costing you what, right? Yeah, you might get a $25,000 bill from your contractor who did flooring and bathrooms and roof repair and all these things. But if it's broken out, you can see, okay, or your CPA can see, hey, that's depreciated over 7 years. That's depreciated over 27 years. That's depreciated over 5 years, and it qualifies for bonus depreciation. So as the taxpayer, as the person in this space, what can you do? What's next? It's not just my goal to just throw a bunch of information at you. I want you as investors, as flippers, wholesalers, developers, you guys need to be aware of this. You guys need to make sure that things are being accurately reported on your books and eventually on your tax return. It's not fun to know that you put $300,000 into a property, it hasn't sold at year end, and you don't qualify for those deductions, but it's what is required of you. This is one of the hardest conversations I have with people who are just becoming new clients. Hey, yeah, you put $300,000 into this property, it hasn't sold yet, you are not eligible for these deductions. They'll come off of your taxes next year, but in the current year, when you put all the money into it, even though you put the money into it, we still need to be ready for a tax bill on the other income we made because we don't get these expenses, right? That is not what I want for any of you. And so by receiving this, by knowing that everything that you have is a capital improvement, you should be having conversations with your tax planner to see what is taxable on your end, what are deductions on your end, right? The person that it matters the most to is the one who has sold a flip or has business income already and then has this next flip that is held at year end and doesn't come off the books because you may have approached it with the mindset like, okay, I made $500,000 on a flip, but I'm paying $300,000 in improvements. I'm only going to tax on $200,000. That's not how it works. And I don't want you to be blindsided by that. So that's number one. Flippers, developers, make sure that you are aware of the capital improvement requirement for your business. Long-term investors, repairs versus capital improvements. De minimis safe harbor, making sure everybody is talking and everyone's on the same page, right? So you are aware of what's a repair and improvement. You get an itemized breakdown of what you're paying for, and every time that you make an improvement or a repair to your property, that then goes to your bookkeeper who is properly recording it as a repair or capital improvement in your books, and then your CPA makes the de minimis safe harbor election so that anything less than $2,500 can be written off as a repair. For those who capitalize and are forced to capitalize because you are greater than that 2,500 or you meet some of the other requirements, like you have to wait until your tenants are out, or it's clearly stated that it's a depreciable property for 27 and a half years, then the question is, what did we invest in? What improvements were made? Are there any that are 5-year properties? Can we do an independent cost segregation by breaking out each asset that we now invested in into its useful lives and making sure that we are getting the maximum amount of depreciation each and every year? That's it. Repairs versus improvements. It could cost you. It could be your best friend. Until next time, God bless you and keep moving forward.